Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day guys, welcome to the show. Phil Tarrant here. I'm the editor of Smart Property Investment. I am joined by my regular co-host, Vivian Kelly. Viv, how you going?
I'm good, thanks, Phil. Happy to be here.
What do you reckon about what the RBA did last Tuesday?
Well, I think it was generally pretty agreed that they were going to keep the cash rate on hold at 1.5%. I don't think anyone was taken aback by that. But subsequently, there's already been speculation by people such as John Calenda from 1300 Home Loan, who's saying that the cash rate could be cut in November down to 1.25%, and that home loan rates are going to start falling regardless. So I think it's a really interesting time of year, and Melbourne Cup will sort of have that extra excitement to it.
What's our readers saying or listeners saying? Are they excited about a rate cut or are they worried about
we
it?
always get amazing reads on our rate cut story, no matter what the RBA does. I mean, a hold story is essentially nothing has happened, keep going, and we still get thousands and thousands of reads. But aside from that, I don't really get the impression that investors are too worried about it. You know, rates are at record lows. I don't think there's anything that they're sort of overly panicked about when it comes to their home loan rates or the cash rate.
Okay, it's good. Well, I want some more information on this. So we've brought someone in who I think can probably chat about it reasonably well. A guy called Mark Bouris. Mark, thanks for coming on, mate.
G'day guys, how you going?
Talk me through what you think about the Tuesday decision, mate.
Not unexpected. I think there's some sort of political bias about not reducing the rate any further because they've got to keep headroom in there for themselves. I think, like if the cash rate was at 3.5%, they probably would have reduced the rate by another 25 basis points. I think at where it is currently, there's not much headroom in case something really goes wrong. And I think they're worried if something goes wrong at a point where they really need super stimulus in the economy. They're not going to get it from the government in fiscal policy, that's for sure. So the only way we can actually stimulate properly the economy is through the cash rate. And given the bank's propensity not to pass on the whole rate reductions, the last one they ranged between 10 and 12 basis points. The bank's held a lot back. I think the RBA would be very concerned about reducing rates irrespective of how the economy's going at the moment. So I don't agree with John Calenda. Because,
Mark, how low is too low? Like if it gets below 1%, will people just start freaking out?
Yeah, I think that's right. I think there's it's sort of counterintuitive, but the lower they make it, the more people start to get really worried, and also the loss of headroom. So they're going to say, oh, hang on, rates can't go down anymore. So what does that mean? What does that mean for me? Should I flood in the marketplace and go start buying property, or should I start to sell? I mean, people get very confused, and we're going to get that American system, the European system, where the rates are so low now that there's got no stimulus in there whatsoever, no matter what they do. So gut feeling is, unless something tragic really happens at the moment, or they foresee something tragic happening, they're going to leave the rates where they are.
Mate, I've wanted to get you on the show for a little while. You're synonymous with mortgages in Australia. What you guys did, 15 years ago, in keeping the banks honest, I think it's brilliant. I like what you're doing now with Yellow Brick Road. It's a business that you head up. In terms of disclosure, I'm a very small shareholder, just so our listeners know, which is good.
Well, in terms of disclosure, I'm a very big shareholder.
But what I liked about the YBR proposition, mate, was that it's very egalitarian. You're saying that, wealth creation should be in the hands of every Australian, whether you're rich or poor. And I think that's absolutely essential. And it's something we try and champion through this podcast. Everyone can invest in property, I feel, if you're a working Australian, if you do it the right way. It's just about doing it the right way. And education is absolutely fundamental to that. So we chat about it all the time. Mate, I hear every single day, when's the right time to get in property? When shouldn't I buy property? My response to that typically is, if you can afford to get in property today, but it needs to be the right property at the right price. There's a whole bunch of rights around it. Mate, what's your sort of view towards Aussie property investors and the opportunity for them to create wealth through property, number one, but also how the hell do you do it and how do you get help along the way? Because a lot of people make mistakes.
One thing you've got to be careful of doing is thinking that someone else has the answers for you. I think that's the first thing. So I really do believe that if you're going to get into the property market, you've got to know the market yourself. So you don't hand it over to a financial planner or a property developer and just sort of run off and do a pre-sale or pre-development purchase, and you go off and say, oh, property developers taught me into buying this, and I should be buying something in, in the highlands of Queensland, because someone's told me that all of a sudden there's a bit of a demand out there. I mean, you've got to do all the homework yourself. You've got to understand the fundamentals of the marketplace yourself, and it's not that hard to do. What you really need to do is go along to someone who's going to teach you about the fundamentals. Go along to seminars, listen to podcasts, but don't go to somewhere where they're actually going to try and load a deal into you at the same time. So as soon as someone starts trying to tell you they're going to sell you something, got something for sale, run for cover, run for the hills, because that's really the wrong place to be. The second fundamental is, I agree with you, it's not about interest rates. I mean, it's about affordability. So to some extent, the lower the interest rates, actually it's probably one of the worst times to buy if you look at the mathematics of it, because there's an inverse relationship between low interest rates or high interest rates and property prices. The property market's a perfect market in that the prices of it actually adjust relative to affordability. So the more rate reductions that you get in the RBA, for example, the more prices adjust up the other direction. In other words, the lower the rates, the higher the purchase price. Because affordability usually stays around about on the same basis. It just adjusts. The market adjusts all the time. So low interest rates could mean high entry price. High interest rates could mean low entry price. So you don't do it because of those sorts of reasons. You do it for fundamentals. What can the bank lend me now? And the bank will make sure I can afford it. Generally speaking, it's very hard to get a loan that you can't afford these days. Generally speaking, as a rule of thumb, banks, people like Yellow Brick Road, we don't approve your loan unless we do the loan assessment at 7.25%, irrespective of the current rate. So we're building in 200 basis points. That's about 8 rate rises into the formula for you. So generally, if we say you can afford it, generally speaking, you can afford it unless you're telling lies in your application. And then you just make sure that you buy where you can afford and rent where you want to live. That's my view. Don't say, oh shit, I want to buy in Paddington, but it's too expensive for me. Don't complain about that. Rent in Paddington, or stay at home with your family, or rent with a friend or half a dozen friends. But go and buy somewhere where you can afford. So you might rent in Paddington and buy in Ballina. I'm not suggesting Ballina's a good place to buy, but that's the process. And you buy what you can afford, and you buy based on fundamentals. Where you buy what you can afford, that's the amount. Where you buy is based on fundamentals. The fundamentals are always the same. Population growth, are there jobs in the area? What's the economics of the area? In other words, what drives the area? Is it driven just by tourism, or has it got some basic industry in there? Is there schools? Is there amenities? Is there somewhere families want to go? What's the demand? What's the population growth? Those sort of fundamentals.
Yeah. We always say on the show, investing in property is not hard. There's a lot of moving parts that you got to get right, but it's not hard, right? What do you invest in property? You invest in property, it's wealth creation mainly. So you buy a property because you want the thing to go up in value, and you want essentially the rent to underwrite the cost of the mortgage and other costs as much as possible. So it's usually good. It's not hard, right?
Yep.
It's pretty simple.
Yep.
A lot of people make it very, very complicated. And you said before, when you hear blokes trying to flog you off-plan purchase, or, you got to work out what the cash is, red flags should go up. Now, you've been in this game for a while, right? A lot of people that I speak to in property investment, they get so engrossed in all the information that they never ever make a decision. A bloke like you, you understand how mortgages are made, how mortgages are priced, et cetera, and then you've got on the other side property markets, and you're pretty in tune with what's going on. You get all this information, you can make confident decisions on what you should be doing. But you speak to punters on the street who get all this information and they're gonna buy property all day. What do you say to them to say, cut a lot of the noise out, cut a lot of the bullshit out of it, and just get on with doing it? Because the best thing you can do in property investing is sometimes just get started, right?
Correct. We'll do something about it. That's what Nike says, just do it. I would say to somebody, just keep it nice and simple. First point, what you just said, don't buy the property because you want to get negative gearing. So just put negative gearing aside. Negative gearing is a tax deduction of the difference between the rent you pay and the interest you pay. In other words, interest is higher than the rent. The reason you get a tax deduction is because you're losing money. So that's not why you go into investment property if you can avoid it in the first place. So let's not think we should be buying property in negative gearing purposes. So I want to put it clear on the table, put aside the concept of negative gearing. If you somehow can manage it, great. But if you're losing money, it's no good to you. So the first thing you should be trying to do is buy a property which has a yield or a return or the rent after all the deductions. In other words, after you pay the strata title people and you pay some maintenance and you pay the person who's collecting the rent for you, has a net rent, which is close enough to the interest you've got to pay on the amount that you borrow for. Second thing, so that once you've done that, you've got to look at an area who delivers that sort of rent relative to the purchase price. Once you've done that, you find, okay, now which property am I going to get in that area? Which is what you find one that's close to the property that's close to the schools, it's close to transport, it's close to parks, it's close to shops or coffee shops, because people will pay more for lifestyle. Put it the other way. Don't go getting a property that's so far away from everything that no one wants to live there, because you're not going to get your return and no one's going to want to buy it. And then, as I said, finally, don't try and load yourself up. Don't try and borrow to the max. Try and buy something you can afford. Don't put too much pressure on yourself. So they're the sort of three things that I look at to start off with. And if you qualify in all those or if you qualify all those three, then just go and do the deal. Just
get on with it.
Don't stuff around, and do one. And then as it starts to wash its face and you start to make a little bit of money, and let's ride the momentum of property price rises. Property prices rise, generally speaking, in this country, particularly in the major cities, Sydney, Melbourne, Brisbane, every year. So where your equity is is in the property price rises. And now use your property as some sort of discipline. So you say, okay, I've got a mortgage, my repayments are $2,000 a month, I can afford $2,300. Start to build some equity in your mortgage, not the property, but equity in the mortgage. In other words, pay more off if you can. Now, that equity in the mortgage allows you to have a redraw. Every product these days has got a redraw. And when you get to a point where you've actually forced yourself to save some more, you might want to redraw that money and invest in another property. And you may, or alternatively, you might want to repay that debt out completely and reborrow up to 80% of the new value of the property because it's increased in value. You've got to start to use your mortgage as a tool and use your property as a tool to build your portfolio.
So we're pro-advice. I'm pro-advice. I've built a really nice property portfolio, and I don't claim that it's because of my brilliance. I'm just being smart enough to actually use very bright people to tell me what to do. So number one, I made a decision to use people to help me do it, and I've let them go about doing what they should be doing. Right, I've got a really good accountant. I use a buyer's agent. I've got a really good mortgage broker. They've helped mentor me on understanding how you can create wealth through property, but I turn to them for pretty much every decision. They do it really well. Right, it's money well spent. Just sort of the psyche of most Australians, a lot of people are reluctant to use advisors. And mind boggles to me why that happens. A mortgage broker doesn't cost you anything, for example, right? You guys now, Yellow Brick Road, you got, I don't know how many branches, but branches right across Australia. When people walk in off the street or they have some sort of connectivity with one of your branch managers or franchises, or what do you call them? What are you hearing on the street? Where are Australians at the moment? Where are they at the moment with actually getting in front of people and asking questions, asking the right questions to advisors or even looking for advice? Do you think is where it should be, or do you think there's a lot of growth still in that space?
Oh, heaps of growth. I actually think that the Australians, well, the feedback I'm getting is people are trying to overcomplicate things. They're trying to build complicated portfolios of asset classes. And, they're looking at, should I buy hybrids? Should I buy equities in the market? And what level of property portfolio should I buy? And should I be buying LPTs? And just listen, guys, let's just keep it nice and simple. Real nice and simple. Maybe you put your super, which might be run by somebody else, you can have that in the equity market. And perhaps you've got a little extra super there. You might want to think about investing in a property and borrowing some money in your super fund. But keep it nice and simple. And outside of the super, maybe you want to build a small property portfolio and we'll start off with one property anyway. Just keep it nice and simple. Problem is, and to your point before, Australians, when they are, our experiences, when they are seeking advice, when they go into one of our branches and want to talk to one of our planners, the stuff they're asking is so complex. It's based on a whole lot of stuff they're reading, and they don't know what they're doing. And they're trying to build something like Warren Buffett would be sort of freaking out at. They don't try to keep it simple. So we're holding a series of talks this month about prosperity through property. We're just actually trying to bring people back to the beginning, back to the fundamentals, back to the simple stuff. Just buy an investment, get it cash flow positive. Then what you learn from that, as you just said, what you learn from that, you learn about the mortgage, you learn about how you get someone to go and find the property for you, and you learn how to manage it. Then go and do another one, and then do another one.
So how do we get this message out there? Because we've been, banging on about it for years, Viv. That it is quite a simple thing to do, right?
I think it's quite interesting, both of your points about that sort of inertia in terms of getting advice. In the first week of October, we had a podcast go out with Simon Liu. He's 31. He's got 11 properties. And, he admitted this huge mistake where he couldn't be bothered to sort of pay for a pest and building inspection, and that resulted in a poor property purchase. He admits now that was a mistake, but so many people do that, a couple of $100s for something that's worth hundreds of thousands of dollars, and people balk at it and people think they don't want to spend money on it. And there's a bit of a disconnect there. I'm not going to spend a couple of $100s, but I am willing to throw $500,000 at something. So I just think people need to sort of look at that, spend money to make money, and sort of learn to re-rationalise that in their head, because it's just a bit bizarre.
It's interesting you said that, because that's a good point. People, if they just look at the process, and someone wrote them a piece of paper with the process, get a pest and building inspection, make sure there's no asbestos in the place, make sure that there's no borers in the floor. Before you go and exchange contracts, make sure that when you exchange contracts, this is what's in the list. You get an insurance policy on the property, because the moment you exchange, you're actually on the hook for the insurance of the property. Make sure. There's like a half a dozen things, maybe a dozen things, and if they just need to repeat these things. It's all about consistency and persistency. The wealthy people I know who have big property portfolios, and like the Asian community, the Chinese community, they do it. They're buying one a year, or one every 2 years, and they make a commitment for 10 years. They're not saying, is it going to go up? I went to a dinner party and I found out our property prices, someone got less than what we paid for. It's irrelevant. If you can afford the repayments, you're looking at a 10-year cycle. Hang in there for 10 years, 20 years, 30 years. It doesn't really matter. You can have it to the day you die, because by that time it's probably giving you such good positive rents that it's going to pay for your kids' school fees. That's the way you look at it, not whether it's gone up this year or that month or this month. That's the problem in the Australian psyche. We are always thinking about, has it gone up, has it gone down? I heard someone say the other day that they sold the house around the corner from me and it's actually less than what I paid for it, my house. Oh, shit. And then you start talking to your partner about it. Dinner party discussions.
Yeah.
We're preoccupied.
They're not property advisors, right? Guys
Correct,
at
they're
dinner
not.
parties and barbecues, right?
No, but that's where we listen to, and that's crazy. I mean, we should have a long-term view on it and just go through the process. And that's why the Asian community is so smart when it comes to investing in property. They never sell. They're just buying for the accumulation purposes. And if you just think about the fundamentals of that, as populations grow, cities' populations are going to grow, there's people got to live somewhere. And the reason why cities' population are going to grow is this is where the jobs are. So people are going to come flocking in here. They're either got to own or rent, one of the two. They can't.
There's no other option.
There's no other option.
Yeah.
So in 10 years' time, you can imagine there's going to be huge demand for properties here. So it's going to go up. Whether it goes up by 5% or less than the CPI, or more than the CPI, or double the same rate it's been going over the last 5 years, is really irrelevant. It's just going to go up. So the game for you is to make sure that you hold for as long as you can. That's the deal.
Yeah.
Simple.
You've got to get in the game first.
Got to get in.
Get in there. It's really interesting, when you look at Australia, great place to live, it's brilliant being Australian. You look at our economic health, we haven't had a recession for 20-something years, right? We've had pretty good times, yeah? Australians love property, brilliant, big tick. The strength of our property market buoys up our banks, big tick. We're strong, we're stable. The opportunities and capacities for Australia to create wealth through property is huge.
Bigger than other places in the world, I should say.
Absolutely.
I want to say that, Philip, because there's a reason for that. There's no country in the world, particularly as big as as a continent, that has such population concentration in 3 cities. Like if you go to America, there's not one city that dominates like Sydney, Melbourne, Brisbane dominate in our holding of our population, and the reason for that is our geography. You can't actually build a big city in the middle of Australia or in some other part of New South Wales because it's just not livable and the infrastructure's not there and it's too expensive and it's just not going to happen. So our 3 big cities are going to have more than 55% of our population. So that's where the jobs are going to be, that's where the people are going to live, and that's where the property price is going to be. And that's why property prices continue to rise in those 3 cities, irrespective of what the economist wants to keep saying and what whatever his name is, that bloke from America who keeps coming over and saying we're going to have a
40% overpriced.
Yeah, all that. It's all bullshit
Yeah.
because we have a specific set of circumstances that address Australia, and it's a lot to do with our geography and the size of our country and the infrastructure that we don't have. And therefore, property prices will continue on unless some government says, an Australian government says, oh, we've decided we're going to invest billions and billions of dollars into some part of the northwestern New South Wales, and we're going to build a new city which is going to attract all the business out of Sydney and put it into this place, which is totally unlikely, and therefore we're far more protected from the swings that other countries get.
Yeah, and I think you made a good point as well. We're protected from ourselves. A bank or guys like yourselves aren't going to lend. They're not going to give someone too much money so they're going to find themselves in trouble, right?
Because we can't.
You can't do it.
The regulator won't let us do it.
Yeah.
The mortgage insurers who are a part of every transaction will not let us do it.
And a bank's not going to overvalue a property because they think they want to give you more cash, right?
Around the other way.
They're going to go the other way, right?
Correct.
On the conservative
I mean,
side.
I think it's interesting when they try, like people like Dent in the US who try and
Dent, that's what
draw
I'm talking about, Harry Dent.
who try and draw comparisons between the US and Australia. I mean, they had things that were called ninja loans, which was no income, no job, no assets or something like that. And they were lending these people money.
110%.
Yeah, we don't have anything like that here. We've always been, some people argue over-regulated. So we're not going to end up in a situation where people with no income have a loan worth more than their property.
I had a debate with Harry Dent years ago, a public debate in 2 forums, and Harry came out with this outrageous number. He said that the property to income ratio, property price income to income ratio, which is like an asset class price to income ratio, which is a typical ratio used for all asset classes, is dangerous when it's more than 10 to 1. So, in other words, if a property's worth $1 million and the average income is only $90,000 in Australia, therefore the properties are priced too much. And that ratio is used for lots of things. Now, he came out and he said The Economist had done an analysis that in Australia, that ratio was beyond 10 times. And when I went and did an analysis of the economists' analysis, they used a group called Demographia. And Demographia actually were using Sydney house prices versus the national income. So, and when I went back and redid the analysis, I did Sydney house prices against Sydney incomes, and I did Australian house prices against Australian incomes. We found that the ratio was only 6.5. It was actually in the sweet spot. So Harry lost the debate because he was using wrong information. Now, he was using the wrong information because it suited him, because he was selling a book that was he was trying to promote in Australia. And this is the sort of stuff I'm talking about, listening to people who are spruiking something they're trying to sell. Now, and Harry's come back a couple of times and we've had more debates over it. It's very easy for people to say that. It's very easy for the economists to bag Australia. It's very easy for the groups like Demographia to go and bag Australia. The only people you should listen to in relation to what is the true ratios around what we do is the Reserve Bank. And the Reserve Bank every half year prints out what they call the Financial Stability Report. And in that Financial Stability Report, they do this calculation. And this calculation still sits between 6 and 10. Now, that doesn't mean that in some parts of Sydney, for example, Chatswood, I'm not saying Chatswood, but let's pick an area like Chatswood. Let's say that the property price to income ratio in Chatswood may be more than 10, but there might be an exception for that reason. And the reason for that is that people are borrowing less because maybe they've got a lot of foreign money in or they've got more cash, or whatever. I mean, there might be people trying to build migration schemes. There could be a whole lot of reasons, and those numbers will distort the total market. So you've got to be very careful about applying these ratios that people like Harry Dent goes around using to promote his own argument in order to promote his book about talking about a catastrophe that's going to occur in Australia. It frightens the shit out of people. And I guess what I'm trying to say here is go back to fundamentals. If someone promotes something that looks like a fundamental to scare you into buying something or scare you out of buying something, go back to the fundamental and do an examination. And this is where what I'm talking about, what you're talking about, Philip. You go along to an advisor and say, could you just give me some advice on this? You don't want the advisor to say, buy on the left-hand side, odd numbers only, on the Pacific Highway near Ballina. Because, a financial planner doesn't actually know that. And by the way, no one knows that. You can know that. But what you want to ask is, what are the fundamentals that I should be looking at? Asset to price, asset to income ratios. What is the current interest rate? Is it affordable? How does it fit within my portfolio? Should I use my super fund to buy it? Those are the sorts of fundamentals you need to get your head around. And what's it look like in a 10-year plan? And how does it fit into my, my superannuation for the day I want to retire? Blah, blah. I mean, they're general conversations, but they're the things no one talks about. Everybody gets into minutiae all the time.
Yeah. Keep it simple. Viv, we're out of time.
Always do, Phil.
That's good. I'm going to try and summarise this chat. You can fill it in if I miss anything, mate.
Sorry, I've been doing plenty of filling. I'll pull back.
Well, what I'd say, and this is good because I like the way you frame it, because there's no bullshit in property, right? It's just get on with it, get educated, right? You need to actually understand what you're doing and what you're trying to achieve, number one. So I'd say my first point would be, got to get educated. Education is empowerment, right? If you're not empowered to make the right decisions, you're probably going to go wrong. Another point I'd make is you got to get in the game. So sitting on the sidelines, waiting for the right time, right moment, right property, right day of the month, whatever it is. If you're not in the game, you're not going to experience some of the growth that we're going to see. And you made some really good points, Mark, around Sydney, the East Coast in particular, around population drivers and how that's going to help support and sustain good price growth over time. So that's really important. Get the right advice. Absolutely fundamental. And what is the right advice? You need to sort that out yourself. There's some exceptional people around in the marketplace right now across accounting, financial planning, buyers agents, and in particular mortgage brokers who can actually help you steer you down the path of where you need to go and tap these people up. That's their job, is to help you out. And I guess that's linked in with this red flag thing, mate. If it's too good to be true, it's probably not. So if you can't understand it, if you don't even get the terms or even comprehend the terms, don't touch it. And if you're not sure, ask someone about it. That's how I'd probably sort of summarise this 20 minutes, mate.
I agree, and just do your homework. I mean, do it yourself too. I mean, actually try and understand, why am I buying this property? Or do I think that the rent will equal the interest? How do I know what the rent is? Who's telling me what the rent is? Who's the person telling me what the rent is? Is it the developer? Or has someone in the street who's got exactly the same house told me that they are getting $500 a week? Now, does that equal if the developer's saying I'm going to get $650? I mean, maybe I've got to sort of say, well, maybe the $650 is not right. If it doesn't sound right, smell right, or look right, it usually isn't. So just do a bit of homework. Put your boots on, walk around the street and have a look. Don't buy anything unseen. Don't rely on anybody else.
It's good. You got to take responsibility for yourself, and you can do that through education. So, I think Mark mentioned earlier on the guys at YBR are doing some seminars across the East Coast. It's called Prosperity Through Property. I got that right. I was chatting Mark off air really quickly, and he said that these have been really popular. So if you want to get in there, look, highly recommend you get along. Go to ybr.com.au, and I think you can register.
Yep.
There. It's good.
Correct.
Hurry up. I think they're next week or the next
week
couple of
after
weeks.
next.
Week after next.
Sydney, Melbourne, Brisbane.
So if you have problems tracking it down, just contact us. We'll point you in the right direction. If you've got any questions at all for me or for Viv or just in general, you can contact us at editor@smartpropertyinvestment.com.au. Remember to check us out online, www.smartpropertyinvestment.com.au. You check everything out. We'll share this podcast plus some other stuff from Mark. Mark, mate, appreciate you coming. Good to see you.
Cool.
Come back.
Yeah, well, we'll come back.
Yeah.
I enjoyed it. And, I think these things are good. Where people can listen to these, going in the car somewhere, they can get a bit of an idea, or they listen to it together with someone on a Sunday night, as opposed to just blindly watching television, and actually get some value out of things. Not necessarily because I'm talking, but just all these sorts of things around property. They've got to listen more, and they've got to think more about what they're doing.
The best investment you make in property is your education, right?
Absolutely.
So you listen to podcasts?
Yeah.
Digress.
I do,
quickly.
I do.
Yeah. I like your show, the Mark Bouris show.
Yeah, the Mark Bouris show. More about entrepreneurs and innovation and...
Yeah, it's cool. I listen to a lot of podcasts, and I'm really fortunate doing a job that I do, right? I get people like you in the studio or whoever, right? Give them a call and they come in. It's my education. It's absolutely brilliant. It's good fun.
Kerry Packer did. He used to do that. He used to learn everything by... He didn't read. So he used to learn everything learned by talking to other people. I mean, he had the sort of the ability to be able to tap anyone on the shoulder. He could talk to Bill Gates if you wanted to, but...
Sandy.
You do learn a lot when you can ask the questions, but it's cool.
Yeah. But you know what, and I'll finish with this point, is that every single Aussie investing in property has the same opportunity. You pick up the phone, you speak to someone, you ask them the questions you need to know to make the right call.
100%.
That's what it is. Thanks, mate.
Appreciate it.
Viv?
Cool. See you,
Thanks,
Viv.
Phil.
Good one. All right. Thanks, guys. Tune in next week. We'll be back with more stuff on property. Speak to you soon. Bye-bye.